An exceptionally brutal day on Wall Street. The stock market plunged by nearly 900 points at the close. Markets fell on fears of an escalating trade war. The Dow closed down 878 points. The Nasdaq was down 820. The S&P 500 fell by 182 points. Millionaires are made when the stock market crashes. And the bigger the decline, the bigger the opportunity, especially for those who can be greedy when others are fearful. In this analysis, we will show you everything you need to know about the latest market downturn and which stocks could win big as a result. The most important thing that every investor must do is make their moves based on data and facts, not on feelings. That is not always an easy thing to do. We will cover what just caused this latest market drop and why, how far the stocks could fall, and for how long, the best way to be greedy when others are fearful. And, of course, which stocks are worth buying if prices continue to tank. There is a lot of ground to cover, so let's dive right into this latest market downturn. Stock markets around the world dropped as President Trump threatened a new round of tariffs on China. Both the S&P 500 and the Nasdaq posted their worst day since April, after Donald Trump said that he would impose a 100% tariff on all goods imported from China, over and above any other tariffs they are currently paying. And that new tariff is set to be effective on November 1st, just 19 days from now. This is a direct response to China announcing expanded export controls on rare earth elements. These controls include restricting their exports, requiring that foreign companies obtain special licenses to export any products containing even trace amounts of Chinese rare earth materials, even if they're manufactured outside of China, and adding additional restrictions for semiconductors and AI-related products. Now, there are a few important factors that make today's situation different from the Liberation Day tariffs back in April. First, China currently controls around 70% of the world's rare earth supply, and over 90% of all processed rare earth materials and magnets. These are critical components in everything from AI chips and electric vehicle batteries to jet engines and advanced defense systems. So pretty much every market we invest in, at least 7 different rare earth elements go into the chips themselves and into the machines that build them, which means that almost every chip maker and AI hardware company sees some serious supply chain disruptions, thanks to these new export controls. On top of that, China's new export controls include all AI and semiconductor-related software. So AI companies are really getting hit from both sides. Second, while the tariffs on Chinese goods peaked at 145% after Liberation Day back in April, they were quickly lowered to anywhere between 10 and 30% once both sides agreed to a 90-day pause for renegotiations. And there was another extension in August. So even though the trade war tanked the stock market in the short term, it quickly rebounded as both sides came back to the negotiating table. But this time is different. This week's escalations have a much higher starting tariff rate, 100% on top of pre-existing tariffs, instead of just resuming the previous rates, as well as a much broader coverage, which includes not just goods, but also critical materials, port fees, and technology exports. There is also a big shift in the tone here, with President Trump commenting that high-level negotiations might not even take place. This suggests that both sides are willing to endure much more economic pain than they were back in April, which means these tariffs, export controls, and trade restrictions could stick around for much longer than the previous versions. And the big problem with that is that semiconductor supply chains take many years and many billions of dollars to set up. We're talking about building and maintaining huge factories full of extremely expensive and intricate machines, training a specialized staff, and optimizing complex processes. So AI hardware manufacturers aren't just going to pick up and move to another country to avoid these tariffs. They are simply going to pass those added costs on to their customers. In fact, a study by the National Bureau of Economic Research found that the costs of President Trump's trade war back in 2018 were passed entirely on to importers and consumers, While the Federal Reserve said that the 2018 tariffs led to increased job losses and higher prices. Higher unemployment and higher prices mean lower spending by consumers and businesses, which means lower revenues and profits for companies, and ultimately, lower stock prices. That is the direct connection between Trump's tariffs and the stock market going down right now. But how far could the stocks fall? And how worried should investors actually be? We do not want to rely on emotions or gut feelings for the answer. So let's look at some historic market data. This is a chart from First Trust, showing the S&P 500's performance for every bear and bull market, going all the way back to 1942. The x-axis is time, the y-axis is total returns, and the vertical bars show the recessions. It turns out that bull markets last for around 4.3 years, and they return a total of 150% on average, which works out to about a 24% compound annual growth rate. On the flip side, the average bear market only lasts for 11 months, and it draws down by around 32%. So while bear markets are around 50% steeper, bull markets last over 300% longer, returning all of the losses from the bear markets, and then some. This is why millionaires are made when the stock market drops. They become huge windows of opportunity to buy great stocks at deep discounts. This is also why it is so important to focus on long-term investing. It takes years for markets to hit their top and to recover from their bottom. Here is another study that splits the bear markets into their declines versus their recoveries. For example, the S&P 500 dropped by 21.6% over a 15-month period in 1956, and then it took another 11 months to recover from the bottom. But look at what happened during the pandemic, where the S&P 500 dropped by 34% in a single month, and it only took 5 months to recover. There are two big insights from this study that will also make millionaires. First, looking at the data from previous market crashes is not the same as holding your assets through one. Most of us would probably say that we'd rather take the crash from 2020 over the one in 1956, since that one took 15 times longer to bottom out, and it took twice as long to recover. But in reality, the 2020 crash was much, much harder to hold through, since the decline was so sharp and so sudden, averaging almost a 2% decline per trading day for a month straight. The second insight is that even though the shortest bear markets jam all of that panic selling into a matter of weeks, the average bear market actually takes about a year to bottom out and about 2 years to fully recover. Not weeks, but years. That is why it is so important to keep cash on the side and to dollar cost average in over time. So far, we've covered what's causing this latest stock market drop, and we've looked at some important historic data to see how far the stocks could fall and for how long. But how do we know when to be fearful and when to be greedy? The answer is by looking at even more data. This is CNN's Fear and Greed Index. The index goes from 0 to 100, and it is currently showing fear in the market. You can also see a 1-year timeline, which is a good way to see how fast the index fell from greed to fear after President Trump threatened another round of tariffs late last week. This is very useful information for anyone who is looking to be greedy when others are being fearful. What is so useful about the Fear and Greed Index is that it is actually calculated from 7 different market indicators, like stock price momentum, strength, and breadth, the ratio of puts to call options, market volatility, and the demand for stocks versus bonds, all different measures of risk in the market. Out of the 7, the 2 to pay the most attention to are market momentum and volatility. It is a good strategy to dollar cost average into your favorite stocks even more aggressively when the market momentum dips below the 125-day moving average, which is 6 months of trading days. As you can see, we are not there yet. But look at what happened back in April. The market momentum was well below the 6-month average from March 13th all the way to May 7th. which ended up being a great window to buy stocks. And the momentum bottomed out on April 8th, the exact same day that the S&P 500 bottomed out. It is also a good strategy to buy stocks when the VIX, which measures the S&P 500's volatility, spikes to around 30 or higher, which also hasn't happened yet. But if we look back at the VIX in April, we can see that it topped out on April 8th. Again, the exact bottom for the S&P 500. This is a powerful tool for knowing when to be greedy and when to be fearful. And personally, right now is not the time to be greedy just yet. It is time to wait for the VIX to get closer to 30, and for the market momentum to drop below its 6-month average first. Alright, now that we have all of that context, we can talk about which stocks to buy when the time is right. Like I have been saying all year, the foundation of every good long-term portfolio starts with a fund. That is especially true if you are a newer or a more emotional investor with itchy fingers. All of the data that we have looked at throughout this video tracks the S&P 500, but it applies just as much to the NASDAQ 100, since they have so many holdings in common and they tend to move together. The NASDAQ has a few advantages over the S&P, like not being limited to just US companies, and not holding any commercial or investment banks. And since it only holds 100 companies, compared to the S&P's 500, the NASDAQ tends to make higher highs in bull markets and lower lows in bear markets, like the ones we just went over. Exactly what you want when you are being greedy when others are being fearful. When it comes to individual stocks, there are two things to look for. First, you want them to be affected by these latest tariff announcements, since it is unlikely that another 100% tariff on China will last for very long. You also want them to be core holdings for the AI era. That way, even if you are wrong, they are all stocks that you can be comfortable holding for the long term. First up is CoreWeave. CoreWeave is an AI-focused cloud computing company that provides the infrastructure for AI workloads in the form of GPU clusters, high-performance storage, and high-bandwidth networking. Not only does CoreWeave get priority access to NVIDIA's latest GPUs, but they are also one of NVIDIA's biggest investments, which is why it is a stock you can be comfortable holding for years and years. Discounted cash flow models, like Simply Wall Street's, show CoreWeave as being 33% undervalued today. Said another way, CoreWeave's stock would have to go up by 50% to hit its fair value. That's a 50% upside on a company that is sitting at the very center of the AI revolution. Like I said at the start of this video, millionaires are made when the stock market crashes. And now you can see why. The next company to be watching like a hawk is Amazon. There is no doubt that an additional 100% tariff on Chinese goods is going to affect their e-commerce business. And the same is true on the AI chip and software side for Amazon Web Services. Amazon currently trades at a price-to-earnings ratio of 33, which is below its average for the last 2 years. And according to DCF models, Amazon is currently 20% undervalued, which means it already has a 25% upside from today's prices. But that is a conservative estimate, because analysts and models tend to undervalue the growth of Amazon Web Services and Amazon's advertising business. Most investors still do not realize that Amazon is the 4th fastest growing advertising company on the planet, only behind Mercado Libre, Reddit, and TikTok. And that is on top of their massive e-commerce and cloud service businesses. It is also the 3rd largest advertising company, only behind Google and Meta Platforms. Speaking of which, Meta Platforms is currently 36% undervalued, giving it a 56% upside from today's prices. Talk about an obvious slam dunk investment for the AI era. So hopefully this video has helped you to understand what is causing this latest market downturn, how the bear markets compare to the bull markets, exactly what data to use to be greedy when others are being fearful, and of course, some great stocks to watch for when it is actually time to pull the trigger. Because relying on data instead of on emotions is the best way to get rich without getting lucky. Let me know your thoughts on this market downturn down in the comments below. Are you buying, selling, or holding? If you found this analysis valuable, be sure to hit that like button, subscribe to the channel for more data-driven investment strategies, and share this with anyone who is trying to navigate these volatile times. Thank you for watching, and until next time, stay vigilant.